There are some areas which are still very attractive. In US, for example, there are sectors such as broadcasting, telecom, selected energy names, in which you can still find 10–11% yield for relatively low refinancing risk. In Europe, banks are still relatively attractive, especially on subordinated debt. Asset quality is very high and capital ratios are extremely healthy. As we are approaching the end of the first half of the year, we do believe the outlook for the global economy is overall decently challenging. The first half of the year has been very noisy, with the new US administration challenging much of the conventional wisdom in global economic policy. Trump tariffs are bringing the US tariff rate up to 20%, which is the highest level in the past 40 years. The implication will be a slowing US economy in the second half of the year. While this is still not apparent in hard data, soft data start pointing in that direction. When we look at hiring intention, when we look at capex decision, when we look at guidance from US corporates, they are all pointing south, and the level of economic uncertainty is extremely high, which is another leading indicator for macroeconomic weakness. In May, jobs report have been a bit lower when compared to the multi-month average in previous months. And at the same time, job revisions in US are starting coming down in a very decisive way. So when we look at soft data and when we look a little bit at the hard data, we can see that the US economy is starting to slow. At the same time, policy is restrictive for once. We know that for the past 3 years, fiscal policy has been a big driver of US macro performance. But Trump tariffs mean a big increase in global taxes. So trade policy for the first time is turning very restrictive. Just in April and May, the US custom has collected around $40 billion in tariffs, suggesting some resources are already leaving the real economy. Fiscal policy, of course, will be the other important part of the equation, but the difference between now and 1 year ago is that the attention of the bond market on US fiscal policy is very, very high. For this reason, the US government will have very limited room to actually increase the fiscal stimulus too much. And in fact, when we look at the bill which recently passed the House, this big, beautiful bill Trump has been talking about for a long time, is actually way more restrictive than initially feared. Consensus estimates for 2025 budget deficit were around 7% 3 months ago, and right now they hover between 5.5% and 6%. So the US government is also recognizing the reality of limits to fiscal policy and basically delivering a little bit more restrictive fiscal policy than thought. Finally, monetary policy will remain quite restrictive too, because for the US, the increase in tariff means higher inflation expectations, and this will limit the room with which the Fed will be able to cut interest rates. So US macro is slowing, policy is more restrictive, and there is very limited room for the Fed to support the economy, which means lower economic growth and slower macro in US. Outside the US, the situation is similar, if not worse, because you have the same extent of the tariff shock, but also a shock on inflation. Tariffs are bad for growth in US and outside the US, but are positive for US inflation and negative for everyone else. Europe, Asia, and a few emerging markets will then see a negative shock to inflation together with a negative shock on growth, emphasizing this impact on global growth and global macro. So from here, our thinking for the second part of the year in terms of policy and in terms of macro is less policy stimulus and more macroeconomic weakness. We find risk markets very dislocated versus our macro view. Right now, risk markets are at the highest, despite an economy which will likely slow down in the second part of the year. After Liberation Day, the market was very quick in buying back equity risk, and right now we are in a context in which equity multiples are back at the highs, credit spreads are back at the lows, and implied volatility is very close to the lows. So the market became very complacent with the impact of the Trump policy and US policy on global economic growth. For this reason, we think credit investors should be particularly cautious and focus on a few selected opportunities rather than jumping on the trade and buy market beta indiscriminately. Rates markets are probably a bit more interesting here. The first part of the year has been a rat race between potential economic slowdown and potential for fiscal stimulus. For this reason, global curves are not fully capturing the idea of the economic slowdown. As US fiscal policy is turning a bit more restrictive than we thought, and as global central banks, except the Fed, are moving towards a more sustained easing cycle, we think global duration start being very interesting. Just to give you a sense, US real yields on the long end are now just shy of 3%, which is one of the highest levels of the past 20 years. In other words, the market is assigning a very high term premium, fiscal premium, or risk premium to duration in global curves, and this is a good opportunity for investors to add to these trades. Within credit, there are opportunities too, but investors need to be very selective. Right now, high yield spreads hover around 280 basis points to 300 basis points, which is the low of the past 7 years. Considering that credit is a very mean reverting asset class, and considering that economic risks are very high, the overall level of spread in the market is not attractive. There are some areas which are still very attractive. In US, for example, there are sectors such as broadcasting, telecom, selected energy names, in which you can still find 10-11% yield for relatively low refinancing risk. In Europe, banks are still relatively attractive, especially on subordinated debt. Asset quality is very high, and capital ratios are extremely healthy, and there is still some spread in subordinated debt vis-à-vis high-yield markets. In emerging markets, local bonds offer 5 to 8% real yield in an environment in which EM central banks will be able to cut interest rates deeply, particularly given the US dollar is very soft. So overall, the level of risk in markets is too high vis-à-vis the price of risk, and duration is more attractive than credit risk here. Within credit, still, there are interesting opportunities in some segment of the market, so a selective and careful investor can still be rewarded very well